did you? Anything you want.
Gold could fall to $1,046 without negating the bull market. The longer gold sloshes between $1,190 and $1,220, the more likely gold is to make a trip lower. Here are the details on just how low gold can go. By Rick Ackerman of Rick's Picks. Gold's tiresome slog over the last month between $11.90 and $12.20 looks increasingly likely to end with a fall to at least $1,165.30, a midpoint hidden pivot support. If the stock fails to get traction there, look for more slippage to $1,109.80. For gold bulls this would not be disastrous, only dispiriting. I still doubt that quotes will fall below $1,000. Not that that's going to cheer you if you've been nurturing a position acquired since 2011, when prices peaked just above $1,900. If you're inclined to look on the bright side, click here. The chart shows that COMEX futures could fall to as low as $1,046 without negating a bullish pattern that projects to as high as $2,278. We should remain open to the possibility, but if you want to be strictly objective about it, set a screen alert at 1,391.40. Since that is where the futures would generate a fresh, bullish impulse leg on the continuous monthly chart shown. Gold price may top $1,300 in 2019 as investors seek sanctuary from the deteriorating trade war. The price of bullion could average $1,350 an ounce in 2019, compared with this year's average of $1,285, according to Bank of America Merrill Lynch. Gold is set to surge over the next year as concerns deepen about the widening U.S. budget deficit and a tariff-driven trade war starts to damage the country's economy, according to Bank of America Merrill Lynch. Bullion could average $1,350 an ounce in 2019 as corporate tax reforms worsen the U.S. fiscal balance, Francisco Blanche, head of Global Commodities and Derivatives Research, said in a phone interview last week. Spot gold traded at $1,208.70 on Friday and has averaged $1,285 this year. We're still pretty constructive longer term on gold, because of worries over the future of the U.S. economy even though it's performing relatively well right now, said New York-based Blanche. In the short run, the effects of strong dollar, higher rates dominate. But in the long run, a huge U.S. government budget deficit is pretty positive for gold, he said. The warning over the budget echoes billionaire hedge fund manager Ray Dalio, who predicted this month that the U.S. economy is about 2 years from a downturn, which will see the dollar plunge as the government prints money to fund a swelling deficit. Goldman Sachs has also joined the chorus of bulls, seeing gold at $1,325 in 12 months. Bullion has been building a base around $1,200 after 5 months of losses, the worst run since 2013. The Congressional Budget Office has predicted the U.S. administration's tax cuts, when combined with new federal spending, will push the budget deficit to $1 trillion in 2020. That's forced the U.S. Treasury to lift note and bond sales to levels last seen in the aftermath of the recession that ended in 2009. The tax changes are lowering the revenue base, said Blanche. That means the Treasury has to borrow more, so that puts pressure on rates, which in the short run has not been good for gold, he said from Hong Kong. However, in the long run, it basically begs the question, can this go on for much longer? Can the U.S. borrow its way out of the next downturn, and at what cost? In the near term, the Federal Reserve is the main driver in determining gold's path. While an interest rate hike is widely expected at the next policy meeting, which ends September 26, the market will scrutinize the statement from the Federal Open Market Committee for any concerns about the threat to U.S. growth posed by trade tensions, which could change tightening expectations, Blanche said. The US and China announced tariffs on $200 billion and $60 billion in each other's goods last week. President Donald Trump has threatened duties on a further $267 billion of made-in-China products, and signaled the trade war will not end anytime soon, telling Fox News it's time to take a stand on China. Eventually the trade wars are going to come back to bite the US, said Blanche. It could take longer, it could take shorter, eventually it's going to happen, but maybe the Fed acknowledges it sooner, which is what people are going to be looking for in terms of getting more bullish on gold. We know that trade wars are not good for the economy.